live. Zooming across the states here. And you're in Georgia, I'm in PA. There we go. Morning, Don. Last day of the first quarter of 2020. And
like the
looks
last
like we're
10
going to
years
close
of my life in the first quarter.
Yeah, it's been an unusual quarter. We're going to take a look at some numbers here with everybody in a moment. But yeah, it's been. Everybody says you shouldn't say this time's different. But I will say I think that this has been unprecedented. So I should ask the first question: are you healthy?
Doing rather well, thank you. We've been pretty diligent, my wife and I, and of course, it's really not too hard for me. I'm kind of a recluse in my own right, but I kind of do what I normally do. But ultimately, I think it is important for us to use good judgment, and so far, I'm doing good.
Yeah, you got enough food and everything? You finding food down there?
Yeah, we have some special times that we can go that have limited number of people and things like that. So
well, we tried that up here too. They opened the stores from 6 a.m. to 7 for senior citizens, and my wife went, and it was packed and crowded, and the lines were way up the aisle. I don't think that they staffed up, at the same time as they opened up. So there were like 2 registers open, and so kind of nuts. We were just looking to pad out our supplies.
Yeah,
we got plenty. I'm always concerned about, if society breaks down. Philadelphia is only 30 miles east of us, and when they run out of food, they're going to come looking for it. I think that's the real problem, is some breakdown in society or food supply. So we got enough food for 3 months and enough bullets for a year.
I see that big field out behind your head there, and you got to be able to plant some turnip greens out there. You'd be all right.
Yeah, we could. That's usually full of corn. So corn or soybeans. So, but it'll take us till October and right now it's the end of March. So before that's producing anything, But unfortunately, that's lavender out behind me. But you can't eat that. But it sure makes you feel good about being hungry. So yeah. Anyway, hey, well, listen. I want to show you a couple things and get your reaction. If you don't mind, I'm going to kind of bring up some stuff here. Can you see that chart? Are you looking at that at the same time I am?
I am looking at it with my glasses on, so I'm.
Today is the 31st. This chart runs through the 27th. We don't have yesterday, which was the 30th. Don't have that on there because my account provider didn't get me statements in time to rerun the chart for up to the latest moment. But that's pretty accurate. Yesterday wasn't a big change in it. But we're looking at, again, an account that I have. This is the light blue line that is at Interactive Brokers. And we're looking at a model account, which we track every day. And we put those two together to see, make sure that our accounts are tracking the same thing. And then we have the red line, which is the S&P 500 cash index. And it's a good way for us to every day we get to look at this and see what's happening. The tracking was very close between the model and the live account for the most part until the volatility hit, and then there were 2 allocation changes that separated these lines. Over time, that's actually likely to correct. But in these periods of high volatility, when we when we record the trade for the model and when we actually place the trade in the live account, we can get different pricing and then different performance based on that. So that's why it's important to track those two together, to see whether or not you actually, what you model and what you test is going to be executable. And we're real happy with that so far. This is a little over a year that we're looking at. It's about 13 months worth of live track record. When I look at this thing, I see a few things, but before I kind of tell you what I'm thinking, I'd love to get your reaction to just how you see that chart.
Well, Paul, I think the two cornerstones, the way we've built our models, have to do with capital preservation as well as long-term compounding. If you have legitimate models that honestly deal with those two things, this is a perfect picture.
Mm-hmm.
As you can see in the center of the chart, they got three little dips, 4 or 5% kind of corrected.
This area here, yeah.
And if you'll notice, we just went plowing right along. And so it's built about capital preservation. And then as you get into the real strong up move, I guess maybe November and December up to the very peak, we just basically kept up with the market for the most part. And that's about as good as you can do because we have portions of our assets in the bond market. So we're keeping up with about 60% in stocks. And then we hit this peak.
Yeah.
Never seen one like it. There's never been one in history of going from an all-time high to a pretty sharp shakeout here.
Yes. Is that what you call it? A sharp shakeout? All right. I call it jumping off a cliff.
Well, I got some others, but we wouldn't get the podcast.
Right. Not good for polite company.
But as you can see, we went down some, and it is tough to deal with, but we have a lot better chance to get back to all-time highs from where we are than maybe some of the index driven kinds of things. So that I could say from a compounding standpoint, we're a lot more likely to get the positive compounding than just the index. And of course, capital preservation. So I feel comfortable. One quick comment about the difference between the live account and the model is that I have the same kind of thing. Is that I have sometimes significant differences in a Schwab account versus a Fidelity account, just because of when we bought them, and we own some pretty volatile issues in there, and just from buying them at 10:30 and then and get the other accounts done to get to the next account. So those are expected, but it'll work out the other way over time.
Yep, I agree.
That's an awesome picture, and it's exactly what Stone Barn's about, for as I'm concerned.
That's right. I will say this, that that I in my office I have stuff up on the screens all day long, and so I am kind of watching this tick by tick, which is not necessarily a smart thing to do, but it's like crack for me. Once I start, I can't stop. It's tough when you look at the bounce off the bottom here for the S&P. That's 1, 2, 3 days from that bottom to that top. And that was about a 10 or 12% recovery in 3 days. 10 or 12%, that's a good year in many times. I mean, think about the S&P, since 2009 up to this peak, was running about 15% annualized return. Now at this point, that took it back to about a 11 or 12% annualized return, since 2009, and that jump was equal to one of those years, of compounded growth. that's that's a lot of, it's tough to sit here and watch, let's say, a 9% or 12 or 10% day in the markets, and then up here, end up with a 2.5 to 3% day at the same time, because we're hedged against
Yeah.
this kind of stuff at the same time this is happening. Well, we don't react on a day by day basis. We're a little bit longer term thinking. We don't try to predict bottoms. In fact, in these times, you could not have predicted this top. You could not have predicted this bottom, if this is the bottom, and we
You
don't know
said
it.
it.
But it's tough to watch a day like that and then back into the kitchen at night and say, yeah, oh, well, we only did 3% today, and the wife says, well, wait a minute, the markets are up 10. Oh yeah, I know, but we're hedged, so, and we got a lot of bonds in there right now. So it's tough to do. But then I go and I look at tables that compare, some of the different metrics we have, and you start to get a feel for how important that gap is between where we really are, where we are, and where the market is.
Yeah.
I'm gonna slide down here to those tables right now, because this is on our weekly update that we send out. You'll know that what in the world is this? Okay, there we go. You'll know that I was talking about being happy, and looking at these things is what makes and keeps me happy. Um, there's an awful lot of digits here, and so I'm not going to do much here. I'm not going to move it around a lot, but I am going to point out a few things. This is as of the close on Friday, last Friday. Here we are on Tuesday, and again, we didn't have Monday's numbers because they didn't send them down to me yet. But for the quarter to date, if we look at that chart that we were just looking at, this is the actual model right here on that line. Okay, so if we look at these numbers for the last week, the S&P 500 was actually down 6.25%. We were down 1.25%. That's a win. That is a big win. No matter that it had a 10% day, or followed by a 6% day, or whatever it was. Um, that was a huge win for the week. If we look at the quarter to date, the S&P 500 is down 21 and almost 21.5%. We're down we're down about 1 1/3. That is an amazing contrast. Year to date, on the year, we're essentially flat. Being down 1 1/3% at this point in the first quarter of the year, when the market is down over 20, that's a win. Then the market itself is down at this point in time, as of Friday, it was down 25% from its high. We were down 9. Big difference. And the real number here that matters, we've showed this before, and so I feel like we're kind of covering well-trodden ground. But if this is the first time you've ever tuned into us and looked at us, then you need to know that we live and die by this recovery number. We are down 8.8% in our portfolios. That's real money. We are, in order to get back to even, we need to do a little over 9.5% return. When we've done a 9.5% return from this point, we'll be back to even. The S&P has to do a 33% return to get back to even from where it sits right now. The opportunities for us to stay ahead are huge, but even more importantly, if you were a buy and hold investor and you sat through this, you've got a lot more work to do to get back to even than I do or you do, Don. That number.
Absolutely. Absolutely. I think that while the numbers speak for themselves, I think just sometimes the fact that we're accomplishing what we set out to accomplish is satisfying. But you know, as I like to say is that, you know, we're actually doing what we're presenting here for you to have an opportunity to dig in and go with us also.
That's right. And, you know, we're these ETF models now, they're only available through professional advisors. We put this stuff up and we watch it every day, and we actually email this stuff out on weekly updates because a lot of advisors track and watch this stuff. So it's there. But, you know, if somebody's interested in talking to us about how to get a hold of that, you know, use these things, you know, just, you know, drop us a note. But the we have live accounts in each of these ETF models, and they're tracking very, very closely with what you're seeing here. So, you know, these are not hedged, but you look at this dynamic allocation. I trade that at TD Ameritrade. I've got an account there that where I have this in place. Over the last 12 months, it's been up 12%, compared with the S&P, which over the last 12 months is down 9. That's a huge gap. Now, it doesn't mean that I'm making new highs every day, but I'm only 3.5% off in that account of my all-time high. You know, I don't have very far to go. You know, you know, these things, the stable risk, you know, is one that we run for a lot of seniors take advantage of that. You know, all these numbers are positive, you know, on the year, on the quarter, for last week. And we're not on all, but we're only off 1.2%, you know, from the all-time high. That's our current position. That has operated exactly like it's designed to. So yeah, I'm happy. These things help me sleep at night, and you know that you and I at our ages, a lot of what we're about is teaching, and you know, each of us has done some mentoring, and it's important for us that people know, you know, the truths of investing that you and I have garnered over the last collective, I don't know, 80, 90 years of experience together between the two of us, or as you put it, 30 pounds ago, you know,
Oh,
when
no,
we
more than
started.
that.
Yeah.
1/3.
So, you know, for us, it's a matter of showing that it can be done. We're doing it in real time. We're doing it live. We can actually help do-it-yourself investors by telling you, you know, what to own, when to own it, and how much of it to buy and sell. Where we've gotten away from, for me, I've done forex, I've done day trading, I've done swing trading, and I've settled on what is essentially basically a monthly approach to reallocating my funds to maintain a low volatility portfolio. And the key here is that it does not mean that if you take less risk that you have to settle for less return. Low volatility portfolios offer greater opportunity for return in the long run than high volatility portfolios do. This is what we're living and breathing. This is where our collective years of experience have brought us, and this is what we're preaching. And I hope we can make a difference with this stuff. We'll see.
I'd say, Paul, looking forward just a little bit with the high volatility that's going on, I expect that to continue. It would not surprise me if we didn't go retest the low parts of the index. Within 2 or 3 weeks here, we're going to hit earnings season, and I would imagine there's going to be some earnings disappointments, and that's usually one of the more volatile times of the year. And so we do need to be diligent about our portfolios. We're coming out with some instructions, I guess, one the next day and one day here. And probably be prudent if you're following our portfolios to snap to attention and utilize our thinking that we won't even put in place until the close today. So.
Right. Yep. Yeah. Well, good stuff, Don. I appreciate you. Yeah, I appreciate your your take on this. Let me go back to just our two ugly faces here, and I think looking forward, I've gotten probably you have too in my inbox for the last 2 weeks. It's been nothing but different entities that I follow, track, or have interests in that sending out COVID-19 notices, telling me what they're doing in order to deal with it. From our perspective, offering these portfolios to subscribers and helping other investment advisors manage their clients' accounts. There's not much different that we need to do other than to say you and I are both taking care of ourselves and staying out of the public and trying to stay healthy. And of course, there's no guarantee on that, but we're doing everything we can to make sure that at least the virus doesn't interfere with our lives and our businesses. And so far, it hasn't. I think there's a lot of unforeseens ahead. I think two of the big.
There is a lot of unforeseens, but I'll tell you, if you do a good job, or if we do a good job as we get through this, there'll be some opportunities on the other side that our monthly updates we'll start to grab some of those stocks that are down 40-50% at some point in time. And by not going down with the whole shebang, we will leave from a lot higher level. And that to me is what we're in business for, is to make
absolutely.
And
that's absolutely true. I mean, that is the math and that is the mechanics of it all.
I'll get off my soapbox for the day.
Okay. I'll just say that the unforeseens have to do a lot with how our government reacts to all of this.
Sure.
I certainly think that since the government essentially kind of mandated that we shutter our economy for the most part, that they need to help out with that. But the consequence of that is the additional debt that we take on. That money has to be repaid from somewhere, and since Congress can't create a single dollar, it can't spend a dollar because that it doesn't take out of the economy first. That we're going to sometime have to pay that back, and I'm afraid that what we're doing now to save the economy is going to be a drag on the economy for quite a while. And there are ways to mitigate that I don't hear Congress at this time contemplating. Their answer seems to be more centralized control, and I don't think that that's a good thing in the long run. The other thing will be how long it takes for this virus to essentially run out. Either we get a vaccine or we get a therapeutic treatment that will reduce the risk of getting it, or we find a way to keep it from spreading. If it takes 3 to 6 months, I think we're going to have a very, very long recovery. If we can get out of this in the next month or two, we stand a chance on bouncing back, because a lot of those small businesses will be able to recover. We go much longer than that, and small businesses won't be able to. It'll take a long time to rebuild that small business infrastructure, which, in my view, is kind of the footing on which our economy rests. But those are my thoughts. Free advice is worth what you pay for it. So keep that in mind. And I'll talk to you soon. I'm out of stuff to say about that, because it's all been said on TV. There's nothing left to say.
Yeah. Well, we're going to do our best, and I hope you have a good week.
I'm going to do my best at that. Talk to you later.